Hey everybody, this is Brandon Wells, and you're listening to the WellsWay Podcast. I'm here for our first episode with Justin Wawrzyniak, the Cashflow Cowboy himself. Let's get into it. All right, what's up, Justin, man? Thanks for coming on the first episode of the WellsWay Podcast.
Dude, I'm super excited to be here. I've been watching you put together this studio. It's freaking awesome.
Thank you.
And this podcast is going to be absolutely awesome as well. Add some tremendous value, because I don't know if everyone really knows your awesome story, but I'm glad you had me on. I'll share a little bit about mine, but dude, we connected 6 months ago, and it's like we're in Indianapolis. What was it? A meetup in town. For anyone who's not going to meetups, go to meetups. That's like the best way to get connected. But I don't know. I think we just kind of hit it off. Now we're in the MIH mastermind together. I mean, Indianapolis. I mean, I've moved, so we don't get to see each other as much. Yeah, I'm in Michigan now, but it was just, we really hit it off, and I'm glad you had me on here, and I'm excited to rip it up a little bit here and add some value to your listeners.
Let's go. Yeah, no, I'm excited to learn more about the Cashflow Cowboy himself. Kind of more about your background, how you got started, kind of where you're at and what you're doing now.
Yeah, like why am I wearing this ridiculous cowboy hat around? And branding myself as the Cashflow Cowboy. So, yeah, I actually had a pretty interesting story. I think I like to be like, what's a good, you ever see that Friends episode where it's like Ross and Chandler, they have the couch and they're like, pivot?
Oh, yeah.
Pivot. That is like exactly how I feel like I got into the real estate world. Because I started off, I was an engineer. That's what moved me to Indianapolis. I mean, if you want to take it one pivot back from there, I was a crappy kid and so I actually got in some legal trouble. And I remember being there like overnight, having to do my time, if you want to say overnight, for being an idiot. And I remember being like, this isn't me. Let's pivot. So I pivoted. I went and I got an engineering degree, graduated top of my class, took me to Indianapolis where we met. And I pivoted from there because I realized this wasn't what I wanted to do for the next 40, 50 years of my life, right? So I pivoted into being a realtor. And so I was like, I want to be an investor long term, but I don't know anything. I don't really have any income because I'm about to quit my job, right? So I was like, how can I do this? How can I bridge the gap? So I did 1 year as like a realtor working with other investors in town. And so I learned about investments while also making commission money. So I was good. I replaced the engineering income, which was wild as well because I tried so hard for that degree and then flushed it down the toilet and replaced the income. Didn't need it, right?
Correct.
Yeah, and then got, self-educated. And I think it was meeting the right people, right? The mastermind, the meetups and stuff like that, where then I was like, all right, let's do this. Like, let's take that next step, which was becoming a full-time investor, multifamily real estate investor. And it started off maybe a little slow, right? I mean, we had our first deal, 10-unit property under contract, probably about 4 or 5 months after starting that transition. And then in the last 2 months, man, you've seen it. It's been nuts. I mean, I'm down here looking at
deal after deal.
Deal after deal. I'm down here looking at some property right now that we walked it together. What was that, last Thursday? We're already under
St. Patrick's Day.
St. Patrick's Day. We're walking properties while everyone's downtown hogging up the streets down there, and we sent out an offer. We got that one accepted. So right now I have 4 deals all at once. We got one closing tomorrow, and then probably another 3 with legitimate offers out there right now. And one I'm pretty confident we'll have an update here in the next week. And it went from one building to
that's huge, man. Because everyone that I talk to, they're all complaining about deal flow. Lack thereof, and here you are coming out the gate just this year alone with potentially 5 deals under contract in the first quarter alone. What are you doing a little bit differently than everybody else to get all those deals kind of across your table?
Yeah, well, we are doing direct to seller. That's like kind of all these. I think all of them have been off market in one way or another, whether it's directly to the seller or like. The one we just submitted an offer on last night would have been a pocket listing from a broker, but still off market, right?
Of course.
And it almost feels like with our market being so hot, or at least it has been, where deals are harder to find on market, you kind of have to go down that avenue of trying to get them before there's a ton of competition for them, because there's a lot of people that will overpay for properties right now.
Yeah, at this point. So are you doing, so you're doing direct to seller, which is awesome. Are you doing more mailers, or are you creating lists and then cold calling?
Oh my goodness, we have an awesome system. I wish I would have, I will soon have it out for the public,
Okay.
where I can legitimately like help people out who are trying to do direct to seller. Unfortunately, because I have all these deals, it's like, well, that's kind of the project that's been kind of pushed out of the way a little bit. But what we do is it's pretty much, you get a good list of skip traced properties, right? If you don't know what skip trace is, it's pretty much you find you get a property address and you find the owner's name, you find some owner's phone numbers. Not all of them are good, most of them are bad. And maybe some emails, maybe a mailing address or something like that. And so you can send mailers, we don't. What we actually do is I have a full-time acquisition specialist who takes that leads, and he'll call every single number, and after he calls and leaves the voicemail, he'll leave a text message saying, hey, we just tried to reach you. We're interested in, well, there's two routes. You can go, one, if you live within 30 minutes, say that you're interested in connecting with them and see if there's any synergies, right? Like, you maybe on single family, I don't know if you've ever done any single family stuff.
Some flips, but not really from an investment side.
Yeah, like you can just send them offers sometimes and they'll accept it, right? There'll be so much distress. But if you're going after like a 20, 30, 40 unit apartment building, it's going to be tough to just, catch them without building a relationship. Yeah. It's very important to build a relationship because they're a little bit more sophisticated. So what we like to do is if we're within, or we have someone on our team within like 30 minutes to an hour, maybe an hour of this property, we'll call them for the intention of not to buy their property, but to simply meet for coffee, meet for lunch, something to build a relationship that will ultimately lead into, hey, we want to buy your property, right? And even if it means you just get, you go to coffee and nothing comes of it, they decide they don't want to sell. Maybe you get like a good property manager recommendation like Brandon or something like that, or you get a good vendor recommendation, or you learn a little bit more about the market that you're investing. Well, is well worth it, right? So that's what we like to do. We found the most success calling and texting and trying to connect with them, meet them in person, something, and then keep them in the CRM and follow up. That's important, right? A lot of people drop the ball on that.
I mean, I feel like follow-up is one of those things that just gets dropped in all facets of business.
Yep.
So like one thing that stands out for us as a property management company is if we do our comp shopping, like where we're pretending like we're looking for an apartment, we don't ever get follow-up. So we already know inherently that, hey, if we just call these people back, we're already starting out on a much better footing than what all of our comps are.
So you're saying when you comp shop, like you secret shop another apartment building, right? To try to be like, hey, we're a tenant.
I'm a renter.
Yeah, I'm a renter looking for a room, and they're not following up with you to try to convert you
Correct.
to a wait list or even to a renter. I mean,
most
they're dropping the ball.
Most of the time, we don't get a follow-up at all. And like here, like we have a full like system of you have to make so many contact points within so many hours, so many days.
So you're tracking that.
Yeah, we track all that 100% because it's one of the things that our competitors aren't doing that, and we're already 100%, not 100%, but 35 to 40% more likely to even get that lead just because we're the ones following up to it.
Yeah.
And what's cool is like we actually go through the online process, but also we do the calling process. We want to know what our competitors, or even what our potential acquisition, the current staff there, what their strengths are and what their weaknesses are.
No way. So at what point in your business did you decide to put a little bit more effort on KPIs? Because that's probably what we're lacking big time on our direct to seller. Like our guys just my acquisition specialist just churning, burning. But at the end of the day, it's like, I know he's doing well because we're getting deals, but I can't quantify how well he's doing, right?
Yeah, no, I'd always heard, I've been in the multifamily industry for, going on 13 years now. And for the first 8, I was on site and I'd heard KPIs. We didn't really track them. We were just so in the weeds, filling up units, getting renovations done. But when I got promoted to be a regional manager at a pretty prestigious company here in town, and I had 6 assets under that I was overseeing, 6 different staffs. I kind of knew at that point I needed to have a tracking system in place to be able to keep everything in track. And since then, it just kind of carried over into the WellsWay kind of model. We track everything.
Yeah, I think we've talked about like what your company provides, and I'm always like, is this like a normal amount of like expertise? You're like, definitely not. Like, no, we're gonna make sure you're taken care of. And honestly, I think the tracking is huge. Where I kind of alluded to it earlier, right? The new software and stuff that I'm trying to make for the public to be able to do direct to sell and stuff like that. A huge component of that is analytics, right? KPIs, because I know right now in my business, I'm lacking, and if someone else wants to pick up a new direct seller, I mean, they're going to have the same problems I am. So might as well try to solve that for them up front and help them out.
It sounds like you've solved another problem is like people who invest in multifamily specifically, they're not a success by themselves. So you have that person who loves underwriting, who loves all that data analysis. Maybe they don't love going out meeting investors and raising money. So you found people that can do that kind of stuff on the back end while you're out, wrangling in.
Wheeling and dealing, exactly. Checking on the cattle. Yeah. That's so funny you mentioned that. I really wanted to talk to you about this because I wanted your thoughts on it. So, right now I feel like it's absolute momentum building right now with the business, and things are going really well. The last year though was kind of building that foundation, and a lot of the foundation was team members, the right team members that are helping you, the right partners. And one of the big things that I learned from joining these mastermind events and even going to meetups and stuff is that if you try to do this real estate business alone, it's going to take you a lot longer and it's going to be a lot harder. And instead, like, I just was like, what am I good at, right? Finding deals. That's what I'm good at. Like, I'm a young guy. I was 26 when I got started, right? So I was like, I'm a young guy. I don't have any money, right?
Yeah.
But I got hustle, and I have the ability to communicate with potentially owners and stuff and other investors, see if they want to sell their property. So that was like what I identified as my superpower. But then along the way, I picked up what are the other superpowers out there? One of the big ones for me that I don't love doing, but I've started doing a little more, is underwriting, right? Usually if you're an analytical person, you're a freak in the Excel sheets, right? You can do underwriting and do really well, and that's the value you can add without any capital. The third one would be capital, like whether it's someone that you just have deep pockets that you can fund these deals, or you have the ability to raise capital if it's like a syndication or something. That's a huge value. And then what I was actually going to ask you if you feel the same way here, because we walked those 8 units last week, right? And I remember walking through them as the deal finder and going to you. It's like, so what do you think? How much do we need renovation, right? It's like, what do you think rent comps are and stuff like that? And I realized I don't necessarily know that because I don't have that experience. And I feel like someone with construction background or property management background that can walk a unit or walk a property and go, yeah, that'll be $5,000 there. We can do about $20,000 for a new roof, or paint it. It'll be $6,000 or something, whatever it may be. Just diving in and know those top of your head, like that's invaluable and something that you can bring to like any partnership and make sure that people are buying good assets and their renovation budget is correct, because you probably see it all the time.
I do, yeah. I mean, it's one of those things to where it definitely comes with the experience. I've probably been a part of over 250 unit renovations in my career.
No way.
I mean, in the last 90 days alone, my company would have overseen 68. And then,
just unit turns.
Full unit
full renovations.
Yeah.
Oh my goodness.
And we'll have those done and all rented within that same time frame. So I mean, we've done it, but I wouldn't say that's necessarily a superpower. It's just something that I've gained with experience. And like, we're actually looking to bring on like a capital project manager who that could be their superpower. So for us, it's all about having people on the right seat of the bus. And I want to make sure that I have the best people in every seat. And although we can walk those units and we can tell you that's probably going to be $5,000 for that, I want someone to be able to create that spreadsheet and create a budget that you can then give to your bank and be held to.
Yeah.
Right? So when we're walking them now, it's like, hey, based off my experience, that's going to be $5,000. But then when we go through due diligence, we'll confirm and tighten all those up. I want to be able to have that person from the jump.
Yeah. So it's funny you mentioned that. So I was visiting San Francisco, what was that? a week ago, 2 weeks ago at this point, and it was with one of the investors in our mastermind group puts these events where he kind of pools all his investors together, and this time it was out in the West Coast. They had done the East Coast last year. And so one of the guys that runs Sharpline Equity, one of the hosts of this, his name's Chris Jackson, right? And I remember talking to him about like this teamwork and having the right people on the team. And he's been in it for 10 years, right? He knows exactly what he needs to do to close deals, and they closed a ton of deals last year. It was like 7, and I think Marco raised like 30 million or something crazy like that, right? Attracted 30 million, excuse me.
Yeah.
But one of the cool things about it is someone that they've added to their team was actually another investor in their market who does development, right? So he understands what it costs to develop. So he also understands when things were built correctly and when things were built not correctly. And so they'll have properties under contract, and they'll fly this guy out to the properties, and he'll walk it, and he'll be like, no, we don't want to buy this, right? And they'll lose, 20 grand earnest money or 30 grand earnest money. And the guy feels bad because he's like, oh, did I just kill the deal for you? He's like,
No, you just
Chris is
saved
like,
us.
no, you saved us. You saved us so much
thousands,
money.
yeah.
This is the cost of doing business, right? Especially on these bigger deals. But it's really nice to have someone in there up front that can go, no, we're not doing this. This was poorly done. Move on to the next one. So I think having someone that can eyeball that just up front, maybe the numbers aren't perfect, but someone like that on a team is invaluable. I mean, it's great, especially you probably see it. Like, I want to hear your take on this. Do you ever get investors that come to you with like, here's our business plan. I need you to renovate. I need you to do a new kitchen and stuff, but we got $2,000 budgeted for the whole kitchen per unit. Make it happen.
Yeah, no, that happens more times than I'd like to admit. But it's one of those things where I feel like in the last 3-4 years, investing in multifamily has become this popular thing to do. So people who were just doing flips or had a duplex or a triplex are now starting to come by these 10s, 15s, 50 unit plus, and they're bringing over this single family mentality over to the multifamily, not realizing they're two completely separate avenues of investing in real estate. So I feel like in the last year, we've spent more time mentoring than managing their assets, because we kind of have to protect them from themselves almost, where they'll be like, hey, we want to do this because we heard it on a podcast or some guru said,
Yep.
we should do this. And we're like, oh no, like if you want to do this, here's what's going to happen. And we've been in the game for so long that we can project, hey, if you want to do this, A, B, and C is going to happen, and you don't want this.
Yeah.
So an alternative would be, this is what we would recommend. And I think a lot of our clients would honestly say that we are a take charge type operator versus we're more proactive than reactive. And what I mean by that is when you have a property management company and a client brings you their pro forma and you confirm all the numbers and then you close, the easiest thing for a property manager to do is manage that pro forma. Like, that's the easiest thing they can do. Not us. We'll have a client bring us a pro forma where their rents are underwritten at $615. Let's try to get ACE at 75.
So you're actually pushing.
Oh yeah,
pro forma.
Yeah. So you could talk to several of our clients, and they would say, "Hey, yeah, we underwrote ACE at 75. He's getting 1050," and I kind of have to explain that thought process to them because a lot of clients are so interested on physical occupancy. How many bodies do I have in the doors, right? And that drives me nuts because I would rather get an extra $200 a month in rent, have that unit be vacant an extra 7-8 days, but still get that higher
and make more overall.
Because that vacancy loss gets usually absorbed in that higher rent in the first month, and then it's straight positive cash flow every single month. And sometimes we have to have pretty stern conversations because they're like, our occupancy, we want to get people in the door. And we're like, hey, trust us, give us a week.
Yep.
And then when we do it, and they're like, wow, okay.
That's so funny. We see this all the time. Pretty much every single direct-to-seller property that we have under contract right now has been historically 100% occupied for the last 10 years of ownership. And you look at that and you go, so you just had under market rents for the last 10 years of ownership. Did you enjoy that?
Yeah, no, that's one of those things is like there's property management and there's good property management.
Yeah.
And a good property management or a good operator, in my opinion, isn't okay with just the status quo of like if we're running your asset, the likelihood of you ever hitting 100% occupied is not very high.
Okay.
And if we do, it's going to be for a short amount of time because we're going to bump those rents.
Yeah, everyone's getting bumped. Yeah.
We're going to bump up those rents. But that's why our year-over-year income growth on a lot of our assets is insane. That's why a lot of assets are 3-5-year plans on refi or sell.
Yep.
It's happening year and a half for our clients.
I feel like occupancy rate or vacancy rate, whatever you call it, is in itself a very telling KPI. It's like if you're 100% occupied, it means there's something wrong because you're not trying to push the envelope. And once you push the envelope, you realize that, oh, we could have got an extra, even if it's an extra $50 across 10 units or something, that's a ton of money. That's it.
If you do that, 50 a unit times 10 units off of a 6% cap rate?
Exactly.
That's
Put the cap rate in there.
Crazy amount of value that you just added. And that's how, one thing, I had lunch with a client the other day, and he said, what we liked about you is you look at it like we do. Like you look at it from every decision that you guys make on the asset, it's from the investor point of view. So you can tell us that how much value you created off of the decision that you make, because that's how you look at it.
Yeah, and that's because you know how to invest in real estate, and which is so funny because you'll see this a lot with like the, maybe in the smaller stuff, you'll see it with the brokers, right? And you start talking to them, you're like, hey, I want to buy this smaller investment property, whatever. And they've never done investments. They've never owned an investment property before and stuff, but they're pitching it like they, all these numbers and stuff like that. You're like, how can I lean on you if you don't have my perspective, right? Then at that point, it's like your perspective is probably just to get the commission check, which is fine. I mean, you got to make sure you take care of your people that are helping you find deals with those commission checks. But it's nice to have even a property manager, or a broker, or just other people on your team that have other investments themselves, so you can say, oh, they've been through it, they know what's going on here. I can trust that a little bit more.
No, that's a really good point, and it's one of those things to where you want to take care of the people that take care of you, but you also want to trust the source of the information. Like we all know how accurate seller pro formas are, on their OEMs, right?
20% expense ratios.
Right, and so there are some in our market that do a really good job, and it's their job to paint the asset in the best light for their clients, and I get that. But you have to understand the full operational cycle of an asset when you invest in it. And if you don't, and you just go off of some fancy colored offering memorandum, and you make your decision based off that, you're in for a world of hurt.
Yeah, there's someone in a different group or whatever that I was a part of that she literally was reaching out to me. It was like, hey, I just sold my asset 1031 into this new one, and she had no business doing this because she took all the pro formas that were given, and she leaned on the lender and the broker to have her best interest. Like she was like, oh, they won't steer me wrong, which in a sense is true, but also it's like they're just trying to close a loan, they're trying to close a deal, right, and get paid. So there is a level of you need to be educated enough to like understand how the whole process works, right? And you can protect yourself, and then find realtors and brokers and stuff like that that'll help you out, property managers that'll help you out, right? You mentioned it, the business plan, right? If I give you a pro forma and it's, hey, I want rents to go up to $850, and all your other assets in that area are at $875 or $900, I want you to push them to $875 or $900 without me having to ask, and it sounds like that's something you guys do.
So with that being said, as you're like looking at these deals and you're evaluating your teams, how much thought process do you have before you start go out and tour these deals? Like how much time did you spend building your investment criteria before you paid someone to do your skip tracing? You brought someone on to call all these owners to really build your deal flow.
Yeah, it's really easy to waste money in this industry, right? I can be throwing money at marketing of assets that we don't even want to buy, right? So it's so funny you mentioned that. previously we had a market in Indiana that we were really going after aggressively. And the source of where we got our list was, I can't remember, it was either one of the online sources or maybe the county or something like that. But it had a ton. It was like 50% or more of like conversion houses, right? Because we didn't have good data. We didn't know the unit count on these. So it was outside of our criteria, right? We're usually like 10 to 100 units, BC class type stuff. And we're sitting here and my guy is wasting his time calling these conversion houses where you look at the address and we're just like, no, this is crud. Like, moving on. And so it's funny because we wasted so much money off. Like
time,
time as well, wasted, right? And then so we were like, oh, should we wholesale these and stuff like that? And then it's more of like stay in your lane, right? Now we're getting outside of our lane and we do the bigger stuff. We don't do that, the smaller stuff. So it was like, okay, moving on. Let's just cut our losses. Let's reset. Let's get a fresh list. And that is important. What you want to make sure is that what you're targeting is what you want. And if you don't know what you want, this is very important too when you talk to brokers or other investors and stuff like that. Know your investment criteria, right? Once you know what unit count you're looking for, know what type of real estate you want, commercial, multifamily, industrial, office, single family, whatever it may be. For us, we like the BC class just because we like to be able to force some appreciation, add some value with renovations, maybe. I mean, a lot of what we're getting is actually, you meant operational, right?
Yeah.
We take a self-managing property manager or a cruddy one, and we put in someone that's good, that we trust third party, and next thing you know, the income shoots up significantly, and we have a great asset. And then lastly, we kind of just don't like war zones. Some people, I know you've done some war zone conversion, you've made your investors millions, but we personally stay away from being the slumlord in the D-class assets just because it's a lot of headaches, and I don't think I'm prepared for that level of headache.
Yeah, so you could definitely invest in those areas as long as you understand what your strategy is to kind of be the start of that change in that area. So like if you are looking at a C minus asset.
See how you did that? C minus.
C minus asset. Can you change the tenant profile? Can you create a gated community? Can you do exterior lighting? Can you do events with your residents to really build a small community? And if you don't have the experience with that, definitely stay away from those C minus assets. Yeah. Because it's more than just putting bodies in the unit and then collecting rent. There's a whole organic plan that goes into those. And you're right, we have made our clients a lot of money in the last year and a half by taking over C minus assets and then doing major renovations. But those renovations aren't just the units. It's the exterior security lighting. It's taking a property that's not gated, creating it gated, and then going to your local hospital and say, hey, look, you're right down the road. We just did all these renovations. Let's partner up on a referral program. So now their employees live 10 minutes away from work, and they're paying half of what they would if they were living straight downtown.
So that's how you go in and change the entire
tenant program. Strategy. Yeah, it's a whole strategy that if you don't have the experience, stay away from that. Run away from C minus assets.
Got it. I have a question for you, Mr. I know your company does a lot more than property management. I actually want to ask you a little bit more than that. But since you do have such great experience, one, like where do you see rents and stuff going right now with everything going on? We're a hot market. It seems like coming out of COVID, rents were skyrocketing, month over month. Do you foresee that continuing? Should we be underwriting for 3%, 4%, 5% growth, or should we, kind of be looking at a slowdown period?
No, so, I just got back from the Best Ever conference out in Colorado, which was phenomenal, by the way. And I had expected to go into that and hearing people be a little bit more, cautious. But some of the best economic minds of our industry were like, buy, rents. And that contradicted with my naturally more conservative. Once you have demand that is far outreaching the supply, then you can charge more. I see that happening for another 2-3 years.
Wow.
I really do. And, I think depending on who you talk to, I'm of the mindset that I do think we were at the top of the cycle pre-COVID. And I'm of the mindset that COVID kind of reset that cycle a little bit. So, I think that we have another 2 to 3 years of aggressive rent growth, but we have another 4 to 5 of income growth that we can kind of count on. Now, do you talk to your people, understand what you're getting into, but as the operator that I am, that's what we're seeing. I mean,
that's promising. I'm glad you're seeing it.
It is, and we're seeing it across all our asset classes, our C minus asset classes, but also our A asset classes, where we're seeing some renewal rates are 50%.
Wow.
No, we've raised in the last 90 days. Our average renewal rate's $175.
That's great.
Our highest is $425.
Wow. So you said something. Well, a couple things. One that I really want to highlight, and you said you went to a conference. You talked with people that have high level they probably have tons of apartment units. They probably have a incredible pulse on the economy at a high level, right? And you listen to their opinions on where they think the economy going, rent growth, like that. That's exactly how you need to be, right? You got to leverage people in your network that have that experience, and you take their opinions, right? I'm not going to go ask my next door neighbor that hasn't done an investment property before and ask him, hey, what do you think about the market? You think it's hot? You think it's cold? Where do you think it's going? And they're going to say, oh, it's going to collapse in a year or whatever. What are they basing off? I don't trust what they're basing off.
Well,
so
that's
it's important to have those people in your network.
It is, and that approach is so sound, because what my advice is, and when I speak to multifamily assets specifically. So if you're in the industrial, retail, office, medical, even single family, talk to someone who specializes in that field. But from a multifamily perspective, I mean, there's a reason why people are being extremely bullish on the market right now.
Yeah, we've done that. And that's why you've seen us submitting offers left and right, is because we're not necessarily being overly aggressive, right? We're getting to market.
Yeah.
We're getting to market. And a lot of the assets that we're taking over right now have been the long-time owner that just wants high occupancy. They don't want to deal with the tenant base. And we're seeing in the last year that you can push rents so much higher. There's so much, a couple hundred sometimes below market without even touching the interior of it, just literally paint.
Yeah.
And you can get it up $200, $300. That's unbelievable.
And it's been interesting. So the underwriting has changed that I've seen in the last 2 years, and some of my top tier clients, when they underwrite their deals for their investors, they underwrite the deal that's going to get them, their 8-9% cash on cash, 50% IRR is kind of what everybody's going after right now. But what they're not doing, and I'm trying to get them to be a little bit more aggressive, is it's okay to show a 5.5% income growth versus a 3.5% if you think you can hit 5.5%. I think investors are, and as they should, they're very, very cautious, and they want to be good stewards of their investors' money. But if you underwrite and you can get 900, but 700 gets you your return numbers, don't underwrite at 700.
Yeah.
Right? and it's like one of those things where they want to overpromise.
Yep.
Or
underpromise, overperform. Yeah, no.
Overdeliver.
Yeah.
But it makes them look like, oh, we got a 35% IRR. And like when I see that, I'm like, great. You underwrote, like your underwriting was off. We did that. So it's one of those things, like when you're looking at deals and you're looking at raising money and syndicating deals, how do you underwrite those? Are you underwriting what you truly think you can get, or do you underwrite to kind of what you need to hit the numbers, knowing there's a lot more meat on the bone?
Yeah. I will be probably in the middle of conservative and aggressive, right? I'm not like all in aggressive where, if we don't get a refi in 6 months, like this thing's collapsing type stuff. No, it's like this is like legitimate business plan that we can execute here. And then like if I go and I get a ballpark rental amount, let's say it's like, oh, you can probably get $750 to $850 or something. We'll usually go kind of towards the lower end just to be sure.
Of course.
And then it's like, well, if we hit our metrics at this point, then that's when it's like, we'll do like a deep dive once it's under contract. So my preliminary underwriting is a little conservative, but probably in the middle, a little aggressive too. And that's why I'm able to submit so many offers because a lot of people are like, oh, I need to know every detail. It's like, no, you need to get it under contract so that you can get the information from so that the owner knows you're legit enough to give you that information that you need to round out your underwriting. And usually at the end of the day, the worst thing that can happen is you paid for an inspection, and the inspection came back and you're like, whoa, this is a bad asset, right? I need to get out. So you lost your inspection money. That's fine. It's kind of the cost of doing business, right? The upside is
tuition.
Yeah, the cost of tuition, exactly, Leonard. Yeah. The upside is you now have an opportunity where no other buyers are trying to outbid you for an asset because you have it under contract, which then you can end up buying. So the upside is you buy an asset. The downside is you lost inspection money.
Yeah.
That seems like a pretty good risk-reward situation. And a lot of times the information you find out during the due diligence, and like I'm not suggesting go retrade every deal, but if something comes up that is that significant, that it crushes your numbers and your returns, and you're like, I can't meet these numbers for my investors, tell the seller. And most times they're gonna be like, oh, I didn't even know that was I didn't even realize my property was that bad, or X, Y, Z, and you get a discount, though now it makes sense, right? Or the flip side is, the inspection looks great and you just went conservative on your numbers, and now you're like, oh, this is gravy. Now we have even better metrics that we can go to our investor pool and say, hey, this is what we got. We will, it's still probably a good idea to do the overperform, underdeliver type stuff or whatever. No, opposite way.
Yeah.
We can't keep it. Yeah, trust me, I am overperforming. I promise. But yeah, so that's kind of the way that we go. But you mentioned one thing that we got to touch on before we get out of here, because you're WellsWay Management, right? But you have these top tier clients and stuff that you're doing much more than just management for. Like, what else are you doing? Like, you full circle now? Are you like, you come to me, you want to invest, I'll take care of you?
So WellsWay Management is one arm of WellsWay. WellsWay is really a multifamily investment firm, and within that, we do offer a third-party management service. The WellsWay Management is more known because that's my primary background, is the property management piece, where we're actually looking to transition away of being property manager focused and investor focused, where we go after our own deals, but also invest with also investors like yourself, to where now we can run the deals in-house and be more vertically integrated.
That's awesome, because now it's like literally I just bring you guys on the team as almost like a pseudo management plus asset management. And I know you have the experience to be like, you're not going to steer me into a bad deal or something like that. So really, I only need to focus on either finding a deal or just bringing hey, I want to invest, and you probably even have your sources of finding deals within your markets too. So it is kind of full circle, and it's almost like a partnership at that point.
It is, yeah, and we have found that better aligns our interests with that of our clients, to where if we're in those deals with them, or we bring deals that we want to go after and they invest in, then we have management in-house. There's a lot more control, and I'm not having to kind of manage the smaller 10-unit third-party assets, because I want to get back to a lot of the bigger stuff, as so do you.
Yeah, I want to get those big ones.
Yeah.
Yeah, you guys are full circle. That's awesome. So it's really just, you guys will have, skin in the game speaks louder than everything, right? And it's a lot easier to get partners that way. That's super cool.
Awesome. Well, thanks, Justin. Had an amazing time doing our first podcast. I look to have you back, episode 15, 20-ish, to see how much we've grown.
Oh, yeah.
But this is huge. I mean, thank you. My listeners are going to find a lot of value with what you've had to say.
Dude, Brandon, you're the man. I appreciate it. I'm glad we've got connected at just a random happenstance meetup back in the day. It's turned into a great friendship, so I appreciate you, love your knowledge, and you're going to add so much value to your listeners.
Thank you. Thank you for joining us in the first episode of the WellsWay Podcast with the Cashflow Cowboy himself, Justin Wawrzyniak. If you want to follow him on social media, you can check out his Instagram at Cashflow Cowboy. This is Brandon Wells with the WellsWay Podcast. Thank you for tuning in. Stay tuned for more episodes.